All right, so stocks finished the week with a very small range again, very small, well, average volume, but still average at very low levels. It's a quiet summer week, but it wasn't. Not everything was flat. There's some interesting technical developments from an intermarket standpoint that impact how bullish we expect to be or not going into the rest of the summer. So this, as quiet as this week was, there was actually some pretty important shifts from a technical basis that occurred. So we're going to talk about what those shifts are, what they mean going forward, what sectors benefit or struggle because of it, and how we can take advantage, as always, with the trade idea for the day. So let's go ahead and get started. Today is Friday, June the 28th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, as always, we'll start off taking a look at the market forecast indicator on the S&P 500. You also see, too, that we continue to ride along. Here, let's get rid of those numbers. That's kind of in the way. So we'll get rid of... There we go. So you can see how we're riding along that 38% Fibonacci retracement level. After hitting the 23% retracement. So this is like right in line with, in fact, we closed like the Russell yesterday. Today we closed above the past couple days highs. Now granted, keep in mind, big grain of salt, we got a big risk event coming up this weekend that can definitely impact things. But you see short-term sentiment down there bouncing back in the upper half of the chart. Okay, so we have a bullish posture. This is a red flag. A strong short-term sentiment would suggest a trend change is coming. Unless that short-term sentiment reverses itself and the blue line gets back into the upper reversal zone. So, assuming a positive outcome from this weekend, at least from a market standpoint, who knows what the actual outcome would be? But if the market views it as positive, then you'll see this rally jump up, the blue line jump up to the upside. Then that would nullify that red flag. Otherwise, if we end up peaking right here on the near-term line and drop back below 50 after only one day up above from what would be a lower near-term high point, and then finally eventually break through this near-term low to a lower near-term low point, now we've got a bearish trend developing right at that point, and we'll change the outlook and the expectations and move on from there. You notice the green stickers here. The 3-month, the 6-month, the 1-year returns. If we take a look at the rate of change of those levels, here's the 3-month return. So you can see, we're not too high here. We've had our surge. Usually when you get a surge and you get pullbacks, you get bounced back up to probably around the 10%, high single digits. After the surges, when you make new legs higher, again, here's another surge from a negative level. And then you can see as we continue to trend higher, we weren't going up to these same levels until the very, very end where we really kind of surged and had that big decline. So we've had our surge here. We're not going to get up to 10+% again over 3 months. But we can definitely get into the high single digits. That's on the 3-month rate of change. Of course, if you take a look at the 6-month rate of change, which is the other green tag, so 126 days here, then you'll notice we do have a really high 6-month return. So that doesn't necessarily mean we have to fall, but it's going to definitely hold down price growth to the upside. At least we're not going to get a 10% move in the short term to the upside. We can still go up at these high levels, but it's not too common that we do. We usually will peak around these high levels and work our way down. So that's something that's holding back a little bit. Now finally, if I were to take a look at the 1-year rate of change on this, that's that 1-year return that we saw. Right, here we go. Then you can see, we got an April. Again, we're not too high. We've been a lot higher before. In fact, we were in the high double digits, and here we're just getting to the high single digits after peaking here at relatively low levels. Let me look back in 17 and 18, and just for some perspective here on this, you can kind of see throughout 17 and 18 Where we peaked earlier this year was from a 1 year perspective is actually pretty low. And remember again this idea of sector rotation and how bullish or bearish this pattern is. Of course, this pattern reflects that we haven't been too bullish, that we've been over the last 200 days, that there's been a period of volatility. And again, this is a bullish pattern going forward for 200 days. So keep that in mind when you look at a chart like this and you see that this 1 year chart's rising and has got plenty of room to go up. Even back in 13, 14, 15, it really wasn't until this early part of 16, and this is the part from a Fed policy standpoint and from an inflation standpoint is very we look very similar now, actually, even if the S&P doesn't. The inflation, crude oil, yields, they all bottomed here in 2010. In fact, I tweeted that out earlier as a discussion that we had in class today. So you might want to check this tweet out if you haven't already. This is a segment of our class that we have for technical analysis on Fridays. Premium for premium Market Scholar subscribers. A little snippet of that class. You want to check that out because we really dive into how similar we are now to this period. And what ended up happening here. And we went from really low levels like we did here in 2019 to eventually up to these levels and then beyond, right? And then, these low double digits, which are not even two yet, ended up being the low point. And we had really, really good returns going forward over 1 year periods going forward from there. Of course, the 3 month, you remember the 3 month is still giving us opportunity for growth. It's that 6 month that's not. So we'll kind of keep an eye on that. And what it means to me is, while things may be bullish going forward from here, just because of how low our 3 month returns are, just expect that it will be very slow and grinding because of how high this number 18.2 already is. A lot of that because of that year-to-date figure that we've been doing so well. So if we go up and we go up at a much slower pace, that number will naturally come back down, even without the market necessarily coming down either, because what we see in these other two time frames. All right, if we take a look at the at the Bollinger Bands, which is another element of this. If I can get to it, here we go. My cursor's a little too sensitive there. You can see how getting above this level, but is now 290, getting back above 293, which is right where we're at right now. Getting above that, we can stay. If we close above and stay above it, then again, that all the volume is to the downside. So if we do have a negative outcome, and we do have a lot of volume to support all the way down to about 280. So it's okay if we do come down. Market will just do what it's done. It will continue to trade in this volume channel that it's in. If it breaks out of this to the upside, which again, like right now is around 293, then there is nothing necessarily holding the S&P back from making a decent run. Again, slow and grinding, but a decent run. You can see from an Ichimoku cloud standpoint, after having been bearish on this intermediate pullback, we're right back to being positive, and you can see right back to potentially getting right above this green line again, and then making that run. As we've seen, when you pull back and you get back above it, you continue to make a run. So that's what we expect to see based on all these charts. The Russell 2000 is really the one that kind of stood out the last 2 days and really this whole week. But you notice, it's had a nice little breakout move to the point where its short-term sentiment went from extremely oversold to extremely overbought, which is actually a good sign. It's got a new a new dark green shading. Its moving average has gone from 1521.55 to 1521.86. So it will have a green line on Monday. That combination of green line and dark green shading is a bullish pattern that we're starting a new bullish trend. And this may be telling us, just like it did here first, this may be telling us on the S&P and all the other indexes that we're about to have a similar pattern develop there as well and continue to make our run. And really, if you zoom out on this S&P 500, I've seen a few people talking about this earlier today, but you make this inverted cup and handle, this is not inverted, but just a cup and handle pattern. Once you break through these highs, I wouldn't measure the cup all the way down to that low point more, because again, I think that that low was fluff, right? That FOMC fluff. More, you'd probably measure the bottom of the cup to right about there. At least on the NASDAQ composite would be about 69.10. And then you measure that gap and add it to the top of the cup once you break out to give you an idea of target simply based on that price pattern alone. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. It's also down below the video on the YouTube page if you're watching us there on our YouTube channel. That will notify you when these videos are posted. Also, while you're down there, click the thumbs up icon. That tells me two things. Number one, you got something out of the video today. Number two, you want us to do the video again on Monday. So it's a really quick and easy way to give us feedback. Again, really, it's the only way to give us feedback. So we appreciate it. We look at that every day to see what you're thinking. So you can do that right now while you're watching. Click on that thumbs up icon. Also, comment on the video down below. And let us know what you got out of the video here. You can also join, sorry, stumbling over my words there. You can also join our Market Outlook email list. There's a link that's popping out right there in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content in between videos, as you saw a little example of here today. And then join our Market Outlook community that we've created on Facebook. We also invite you to subscribe to our Market Scholars website. You can do that if you're watching this on our blog, or if you're not, if you can go to marketscholars.com, click on blog, find our post and today's post. This image right here under Join Market Scholars, very easy way to subscribe. You can do it for free. It will allow you access to our forums as well as other content that we provide simply here for subscribers to our site. Of course, premium subscribers to our site get access to all of our classes. That's that segment. I gave you a portion of our segment of my technical analysis class. Here's a couple of Brandon's classes that he has scheduled next week on Monday. We also invite you to engage with us on social media, right? It's, you know, that way Twitter and Facebook know that you want them to push you our stuff. And the way that they know is for you to engage. We try to make it very easy for you. So click this heart. That opens up this window. You can like the Market Outlook tweet here. And you can also retweet it as well. When you get to the page, click on this image, takes you to your Facebook account. You can like it there. Again, that you're liking that content tells us you want us to keep doing it. That's how we see. And it also tells you, Twitter and YouTube or Facebook, that you want them to keep pushing you more stuff. So it's because they won't. You have a timeline full of people that you follow, whether it's on Twitter or Facebook. They can't show you everything because you're not always looking at those timelines. So when you do come back and forth to them, they show you the stuff that you engage with the most. So that's why we're always kind of asking you to engage, and that's why we try to make it as easy as possible for you. All right, back to the charts. Let's take a look at the weekly charts for the market forecast. So let's get, and for that matter, the monthly chart. So let's take a long-term view, and you can see the S&P after having gone through, after having come down to its moving average and bounced off of it. You can see what the weekly chart looks like here, and there's the fans and the retracement that we have drawn before. In fact, I'll just kind of move this off for a second so you can see. There's those lines. You can see we have a strong bullish posture there. The near-term sentiment remains strong with the blue line up there. The near-term, the momentum line's down because of this week's range and the negative outcome, but not to extremes, right? That's actually what we got there, and that was so extreme that ended up being the bounce that we talked about a few weeks ago. I mean, on May 31st, when we did this video, we talked about how bullish that of a pattern that was, and since then, we've rallied pretty darn nicely. A month later, so 4 weeks ago was a month, you know, it's fascinating how things change so quickly, right? That's how bearish we were a month ago. And here, let's get the, let me make sure that it's on log scale. Nope. Here we go. So that's where we were a month ago, and we've completely reversed it to the upside. So with the momentum line, again, how extremely low that was, which is another really bullish sign that we don't get very often, you can see the momentum line bouncing right back up to the top, which, as you can see, we haven't got for over a year for it to be that bullish. So very good sign that the near-term line, which typically does pull back during these kind of monthly, pullbacks here. We had 1 month of a decline that brought the near-term line down. Not as low as these, but pretty darn low, similar to this one over here. And then we'll see if we end up bouncing off of this. Remember how that's the end of 2015. And again, like I said, from a inflation expectation standpoint and crude oil and yields and all that, we actually look more like this on the S&P 500. From an intermarket relationships, we look more like this than we do over here in late 2015. So or early 2015. We have an opportunity here for a pretty decent run if we start coming off of these extreme lows in these other areas. We'll talk more about here in just a minute. Let's now take a look at the long-term chart, and you can see from a Hakunashi standpoint, when you look at the weekly candles, nice, good, bullish candle. We didn't get up to a new high. That's okay. It doesn't always go up to new highs, as you can see in fact, right here on this period. We didn't get up to a new high there either, but we did the next week as we stayed with the bullish candles. You can see the open and the close. There's about 40 plus another 60, 52 points difference. So you add on 26 points to 28.88, and you're looking at 29.14 is where the open's going to be on next week's candle roughly. So, and we're trading right now at 29.41. So as long as we stay up and push up out of this weekend's events, then we'll maintain this bullish trend. We'll get new highs probably, since we're only 20 points off of it to begin with. And then our next risk event will be that July FOMC meeting, as well as the earnings season that comes up next month. All right, so now we look at the intraday chart, and you can see, higher highs and higher lows today. Again, very small range. When you look at the range and the volume today, the range still, 1.5 points, so still below the average. The volume did tick up, about 58 million shares, but still relatively low. So when you look at the range, it was a bullish range. We are bouncing here off of these short-term lows. We had a nice little kind of buying into the close, so getting pretty much, we actually created the high of the day at the very, very end of the day. So this is a pretty relatively bullish close. Again, big asterisk with what's coming up over the weekend here and how bullish or bearish the market might take that to be. But as of right now, the environment is setting up for the market to come out of it with a positive outcome. Again, it doesn't matter what the actual outcome is; it's what the market thinks, and price will reflect what the market thinks. So we'll find out really quickly, probably Sunday night by the time the futures open up. We'll find out pretty quickly. Remember, don't put a lot into futures movements. Big time futures movements with a lot of volume, with little volume, with a lot of volume that's typical for futures, but little volume compared to actual market open. Don't put a lot of context into it, so don't get too wrapped up into what can happen overnight. But it will give us at least an idea of what the markets are thinking there. And again, getting above 293 will be really bullish. Getting above 295, obviously, will continue to be bullish as well. And we'll either I will venture to guess we'll either gap up to the upside or the downside on Monday. And if it is a gap up to the upside, similar to this one, it'll be another one of those breakaway gaps where we, get a decent amount of volume and we don't fill it again for a couple of days. I would venture to guess. Otherwise, we'll gap down to the downside, and we'll see if that ends up being, the bearish gap that we never fill even that one here. If this ends up being the top, we actually did fill in that gap. So, if we do gap down and we say we get down below this 290 level, start filling that one in, and then that's going to be probably one of those runaway gaps where we start a new bearish move to the downside that will persist for a while. Again, just keep in mind, if a lot of that selling occurs overnight on Sunday and we start to fill it in already by Monday morning, then it becomes a common gap, and we're back to, that's very normal. All gaps get filled in. It's the gaps that don't get filled in that either start new moves or break out to continue those moves to the upside with this additional volume there. All right, so we saw the trading range and the volume right about 58 million, still pretty darn low. It looked like it was a decent amount of volume, but that's always in context. It's still pretty low. The range at 1.5 points also very low, well below 1%. So we are according to the ranges and the volumes, entrenched in a bullish trend right now. The one thing that hasn't, because of tomorrow, this weekend, is the VIX. And even then, the VIX dropped at the end of the day. Right at the close, the VIX dropped. On an absolute basis. On a relative basis, it's still kind of in the bearish territory. But again, we've seen this before, and barring the outcome from the weekend, most likely will come back into the neutral zone. And once it gets below 90%, the bullish trend is entrenched, right? The train is completely left the station at that point, and we're going to be trending probably slowly, right? This isn't a bullet train. It's not going to be a bullet train. Bullet trains come off of lows. We're already well off of lows, and the volatility is already going to be relatively low itself. This is going to be one of those slow chug-a-lug trains that you just want to sit and ride and enjoy the scenery while you're in it. All right, before we look at what's driving the price action today, or lack thereof, as well as break down these intermarket relationships with a trade idea to wrap up our video, we'll take a quick pause and just summarize our technical outlook, which is that we maintain this bullish posture and we are providing a short-term bullish environment for a positive outcome to come out of this meeting. Now, again, these leaders of these countries do not look at, well, maybe they do look at the markets, but they don't look at the charts and say, okay, we have a bullish technical environment. Let's go ahead and give them what they want. They will do whatever they think, but the market thinks that there will be a positive outcome as it is producing a bullish short-term environment that allows for the type of bounces we can expect to see. So that's the expectation. We're bullish. We found support in the short term. We're bouncing off of it already, albeit with small ranges and small volumes, but we're bouncing off support. The expectations will continue to now push through these old highs and grind our way through the summer to new highs, similar, as you'll see, to what we've seen before. So what do you think? Now's your time to vote. Click that link right there popping out and hit either agree or disagree. If you click disagree, which is okay, right? We don't always agree with everybody, but if you disagree and you've got something that supports your a different position than what we've taken here, then show that supporting chart, material, whatever it is, article, tweet, post that down in the comment section below for everybody, so that we can be able to see all sides and be able to make up our minds on what we expect the market to do going forward from here. But you have my take, and you can agree with that. And if you disagree with that, like I said, share with me what's driving your take. All right, as mentioned in the class, and as mentioned actually in this video too, crude oil was the other asset class that had a rough finish to the week. But before this finish, you can see it's actually had a really good couple of weeks, as you can see on that chart. And if I were to go to just this week alone to see how things performed, you'll notice that it had a really good week until this last little decline. Still finished the week positive, came in below gold. As you can see, small cap stocks had a really good week as well. Emerging markets also outperformed. In fact, the S&P 500 among this group was actually the worst performing asset class, coming in below preferred stocks, coming in below high yield, until little tiny bounce that caught it up to them at the very end. So interesting pattern. Gold started off the week strong with the weakness in the dollar. The dollar moderated by the end of the week and brought gold down, but still higher for the week as it was. And then foreign stocks outpacing the U.S. Large cap index, if not the small cap, which is way up here. You can see also long-term bonds had a really good week too. So you can see when I take a look at the long-term charts for crude oil, again, it seems like we're coming up off of a low point. Not so extreme on crude, but coming up off of a low point with a nice little breakout these last couple of weeks. And again, it wasn't until today we were trading above the 200-day moving average here. But you can see how the momentum is shifting back to the upside. Again, we were extremely low in 2016, and we saw what happened going into October of 18. Nice little run. If you look at the 10-year yield, same thing. We hit a low point in early 2016. We actually went further down, but we hit that low point there. By the time we got to October of 18, yields rallied too. Yields went from down to this low of 1.6% all the way up to doubling it, with a brief dip to 1.3 in the middle. But you can see how bullish that was, and really you can see how extremely bearish we are now. It's we are about as extremely bearish now as we were back here in the middle of 2016, and for that matter, in early 2015. So and there we got the long lower shadow from last week still holding for support on yields, as well as this big round number at exactly 2% where we closed here this week. And then finally, the other thing I mentioned is this is a weekly chart for inflation expectations, which needs to be updated for today. It hasn't been updated yet. Looks like the week is, but it hasn't been updated yet for today. You can see it's down here. The most recent data should be 2 days ago. It's usually the trend. Update is updated as of yesterday. So we're at 1.83%. So now let's go back to the weekly chart. And you can see similar to early 2016. So here's February 2016. There's that second dip to new lows that we saw here on the yields. Crude oil didn't have as big of a dip in July, but you can see what crude oil did there during this dip in inflation expectations, the second dip below 1.5%. But then we rallied off of those. And so remember, we're as low now on yields as we were here, and you can see what inflation expectations did. Now, I don't think necessarily inflation expectations are rallying back up to close to 3%. That's where we were over here with all that QE. We don't have all that QE, so I don't think we're getting up to there. But are we going to get back up into this area? That's definitely a possibility, which would keep the rate cuts to 1, 2, maybe 3 into next year. Very similar to 1995, where we had a cut in July, a cut in December of 95, and one more in January of 96, and then the markets were able to maintain really strong bullishness. So, when inflation expectations rises, that typically correlates with a bullish move in commodities like crude, a bullish move in yields, which typically also has, shows a bullish move in stocks, led by emerging markets because of weakness in the dollar typically, and led by small cap stocks. As we saw, those are your best performing assets all the way up to at least here. Things deviated from January of 18 to October because of the trade wars, right? They really impacted those international stocks, but kept U.S. stocks afloat, and then things started to fall off. So remember, we're getting a little bit of a, this would be somewhat of a divergence low point here, depending upon what indicators. In fact, if I were to put this chart here onto like this, let's go here, and let's bring up, this is the, let me make sure I got this. This is the December 18, early 19 lows. That's going to be right in here. And you can see, it's relatively low here on the PPO. It's still pretty darn low compared to what we've seen in the past, but relatively low. There's that divergence that showed up there. And then if I look at the two-line versions of the MACD and the stochastics, so we'll bring that chart up here and go to a weekly chart. You can see the divergences setting up there. The higher lows on the MACD, higher lows on the stochastics. We saw that over here as well with the lower lows, and then the higher low on the MACD at that point, and that set the low point. At an extreme low as well over here at the extreme low on the it's 2016. It was July of 16, wasn't it? The extreme lows on yields, right? We set that low point there, similar to how extremely low we are now, and then we all rallied. And like I said, that was really bullish for risk appetite going forward from that point. So let's talk about next week. Of course, the big news will come out over the weekend. And then actually, here we need to get to this. The big news will come out over the weekend. And then we have our national ISM on Monday. So that will be a kind of an important thing to keep an eye on. And then we have a bucket of indicators on Wednesday, and then the employment situation on Friday. We will not be doing a market outlook video on the holiday, of course, but also we won't be doing one on Friday either, as both Brandon and I will be gone for the 4th of July holiday. So keep that in mind. Next week we will have market outlook videos from Monday through Wednesday, but we will not have one on the holiday, of course. as well as on Friday. So we'll wrap up the employment situation on the Monday video on the 8th when we come back. Before I showed you how bullish it was actually for those safe haven sectors who have such a good outperformance over a long period of time, like the last 200 days, how bullish that is going forward from here. If we did just take a look, the pattern for this week from a sector standpoint ended up being a pretty interesting pattern. I've been kind of touching on it all week long here, especially towards the end of the week. But if you notice, during this week where we had relative weakness for most of the week, the S&P was down at one point, 1.25%, still finished relatively down. But you can see what led the weakness to the downside was a drop in real estate stocks and utility stocks, healthcare to some degree, and even staples to some degree. And the safe haven sectors ended up being the worst performing sectors. They've been the best performers, but they ended up this week being the worst performers on a week where we actually were down, not up. That's usually what you see during up weeks. You can see communication services also lagging. It's got a utility element to it, right? On the other end of the spectrum, you can see that materials, financials, and energy, industrials, these dollar sensitive and interest rate sensitive sectors, financials kind of giving us an idea that maybe they really financials struggle when yields fall as much as they have, right? Since that October timeframe when we peaked in October last year, October 3rd roughly, when the market peaked and yields peaked, you can see energy decline. You can see financials really declined initially, and they've been lagging behind. Financials have been lagging the market. The market is barely positive since that October peak. Financials are not. They're hardly negative, but they're barely negative. These dollar sensitive areas are also lagging behind. And you can see the safe havens have done so well. Utilities and real estate really doing well with the drop in yields. Well, if this ends up being the low point for that, then we'd expect that to flip-flop. And we'd expect financials to lead. Technology would lead as well in that environment, as well as these dollar-sensitive areas. And you can see energy has got the most ground to make up from that peak in terms of its underperformance. It's got a lot of ground. If crude oil starts a decent run with rising inflation expectations, then we'd expect these really undervalued, oversold energy stocks to make up some of that ground here. All right, one of the stocks in that embattled financial sector is Wells Fargo. And Wells Fargo actually had a pretty decent day. You see its market sentiment's really low, so it's been down, right? We've had a pullback here, a lot longer than the market's pullback. But we had a nice little breakout move today, so getting above a lot of days and weeks high points today. The intermediate line is bullish, so we have dark green shading, we have dark green line, so it's a bullish posture there. Again, you look at like the 3 green arrows for Wells Fargo, you can see we don't quite have 3 green arrows. The stochastics dipped a little bit, but we have 2, and you can see that the volume was a nice spike in volume today. When you look at the 2-line versions of this, you'll see that it's dipped just a smidgen below its moving average as well, but the momentum is positive, and the 8 and the 17-day moving averages are rising up above. You can see from a trend strength standpoint, we've had a really, really bearish trend for quite a while here on the weekly chart, but you see how the trend has changed. We've been noisy for so long, and now we actually have a bullish trend developing, weak, albeit weak, but a bullish trend developing here on the daily chart. So an interesting change in pattern there, of course, when you look at oops. Here we go. When you look at the Ichimoku cloud, you can see breaking, we've been below the cloud for so long, breaking into the cloud. Of course, we've seen where we can break into the cloud and come right back down. So we'll kind of keep our eyes on any resistance breaks it might make there up in this area. But if we break on through, that can lead to bullishness in the market. So something, a positive development with earnings coming up, mind you. Now keep in mind too that financials do really well when yields and inflation expectations bottom out and turn up, and crude oil is giving us the indication over the last couple of weeks that might be the case with this really, really oversold yield on this technical chart, of course, since you can't buy yield. directly, and as well as the inflation expectations kind of bottoming out themselves on a week-over-week basis. Let's take a look at the Bollinger Bands for Wells Fargo, and you can see the breakout above the upper band. We gotten into the upper half of the chart, and now we finally breaking down. Now there's that when we got to the top of the cloud, so we'll keep our eyes on something like that and see if this holds or not. We do have a lot of resistance, so it's not going to be easy for this to get going here. There's going to be some resistance in this 52, 53 area to the upside. But this is a nice little breakout heading into earnings for this stock that's been so oversold. In fact, on the long-term chart, you can see that we're closing above the 50-day moving average. And we'll see if we end up filling that gap and then some by the time with this divergent low point on the actual index itself, combined with its PPO. As bearish as the PPO is, in fact, more bearish here than it was over in this period, and we had a nice little rally off of those. Again, low inflation expectations. Inflation expectations rallied up to early 2018, and then again to October of 18, and you can see that's a benefit for a stock like this. And then finally, the DMI. I'll take a look at the DMI for this, and you can see the nice cross we like to see. The positive getting above 25, the negative getting below 20. Very low ADX, suggesting that there could be a trend coming out of this if we stay above there for a while. So the nice thing about Wells Fargo is a cheap stock. With this pullback as it is, it's a relatively cheap stock. It's got cheap options. I can buy that at the money option, knowing that by November, and I can go out to November, give it within that 150-day window, but go further out, so give it some time to work with, especially if their earnings has a knee-jerk reaction to the downside. But based off of how far it can move up in November, you can see that I have an opportunity for almost $5 of gain on that $2.50 price. So I'm getting almost a 2-to-1 at full cost. And if I put my stop order at half of that, which again, it could drop, stock could drop on that earnings. But considering how far out in time we are, and the time decay not being a factor, we can give ourselves some time and allow that full cost to develop, that full low point. And if a few weeks to a month or two from now, and we can't, this breakout doesn't hold and earnings is negative, and we're down to half of that loss, and we'll take half, which then would make the return. If I'm only losing $1.20 on this, you can see the $5 reward, or would it be actually $4.70 reward compared to $1.20. It's a pretty decent reward to risk ratio if the stock does indeed eventually take off to the upside. All right, so that wraps us up for today. You've heard from me now. I want to hear from you. Let's keep this conversation going over the weekend into next week. Use that link that's popping out there in the top right corner of your screen. That will take you to our Market Outlook forums on marketscholars.com. Remember, you have to subscribe to our site to open up any new threads or reply to any threads there. But it's free to do that. I showed you how to do that earlier. Open up any new threads, any questions or comments you have about the video today or this weekend, or any questions or comments on something I didn't discuss in the video that relates to this topic. Open up any new threads and reply to anybody else's, and let's keep the dialogue going here. As always, thank you very much for watching our video tonight. Remember to click that thumbs up icon, subscribe to our website, or to our YouTube channel, and comment on the video. Follow me on Twitter for more content in between videos from day to day, and join our community at marketscholars.com, as well as the community we created on Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all next time.